is an exit strategy so important for us? Like, is it a must or a maybe? Do we have to kind of think about our exit strategies, or is this something that we can just kind of have a bit of a handle on? Like, how important is having this exit strategy for us?
Yeah. So for me, the answer is yes to both, depending on who you are. If you are fairly comfortable in your life and you've got a nice steady job and kids and house and you're paying off your PPOR, you don't need a strategy necessarily. You might just be buying a property for some future wealth, and that's fine. Like, not everyone's like you mentioned before, Joe, like all three of us in this kind of video, we're all go-getters. Like, we didn't build a big portfolio from not looking on realestate.com every night till 1 a.m. for a few years. So like we're that type of. So, but the other ones, it's just for some more comfort in retirement. This gives them more options. However, if you've got something that's quite large in terms of goals, then yes, it's a must. And Jordan said it before, you're just kind of buying properties at the start for the sake of buying it. I did as well. I bought, most of my duds were the ones I just bought because I thought they were a good deal and they weren't really fitting in the strategy and my borrowing capacity. So if you got some big goals, you have to have some form of strategy, because if you buy the wrong one or two properties at the start, it's going to tangle out for a while.
Let's start going into these 7 exit strategies, because Steve, you've identified 7 strategies that are going to allow you to exit on property. The first one we've got here is keeping all of your properties and not paying down the debt. Can you talk to that?
Yeah, so I've just tried to summarize like just the general overview, 7 kind of strategies that most people use. There are some other ones, like you can be a developer and all that type of stuff, but these are just the kind of outline ones. So that is basically accumulating your portfolio, and it's normally a self-sustaining one. So it's obviously not going to be highly negatively geared because you're not going to retire from that. So you normally got some passive income from it, and then just leaving it, just letting it kind of keep paying off the P&I typically, and then leaving the capital thing. The benefit of that is you've got a bigger portfolio, because like you've got more assets, you've got more cash flow, and you get inflation over time to help grow the portfolio, and you keep the capital growth, as opposed to selling and transitioning and things like that. You keep it. You also save on the exit and entry costs. So if you're trying to replace the property, you don't have to. You're not paying stamp duty again. You're not paying real estate selling fees of 2%. You're not paying the stamp duty again on the property you place it with. So you're saving 10% there. So it's just Jordan actually gave me a note on this. We went through this before the call. He calls it the natural exit, which I quite like. It's a riskier play. So like, because you do have like a large amount of debt, so you're more subject to like interest rate movements. And then you also just typically can't like refi. Like, you're not going to be able to go interest only for the rest of your life, because the banks, you're not going to be able to service that debt. So you typically have to be P&I as you kind of go on. And this is going to be a recurring theme throughout all these strategies. Speak with your broker and speak with your accountant, because they're the biggest parts of exit strategy. Your broker, obviously, for what type of finance that you're going to have on the property and when you're going to shift to P&I or not pay down debt and things like that. And your accountant for the structures that you're buying under, because there's obviously tax ramifications for selling properties and transitioning them. And especially when you start talking big passive incomes, then there's tax obviously on passive income, and that's where you buy under family trusts and disperse profits to beneficiaries and all that. So this is, we always have it on about this in part of the group. You need the team. Yeah. It's not just buy good quality, but I can buy you the best quality property in the world, but if you buy it under the wrong structure or wrong loan, you can shoot yourself in the foot for 5 years.
Yeah, and also if you want to hand that property over to someone, you have to consider structures as well, because you can't just say, oh, I'm going to give this to my son. They're going to have to go under their name on the title if you've just bought it as an individual, and then you've got to pay stamp duty again. Like, if with a trust, you've got versatility, but obviously, yeah, speak to your professionals and go through.
There's some high net worth investors, they buy under company structures as well, because they've got enough income from it that it can service itself. And then there's options there. They run it like a business. So a lot of my high net worth guys, their property investing is a business. So they've got different structures there. So everyone's different, but that's just the big one. Everyone buys the properties and then they just let it kind of, the LVR erode over time, and it just kind of self-fulfills itself. But Jordan, you got any comments on that one?
Yeah, I really like this one. It's probably my favorite one out of all of them. And you're right. Like, I call it a natural exit because it is natural. Like, there's no forced, like, you have to pay your debt off. There's no forced line in the sand of this is what's going to happen. It's accumulate the portfolio and then let time do its thing. Obviously, sort of like no financial advice. Joe, do you like the disclaimer or anything? But like I personally like having good debt because it gets inflated away. So savings in a bank account gets inflated away, where debt is actually money that you owe to a lender. And so the lender has to cop that inflation on the way out. So today's, dollar that you have to pay back in 10 years might only be worth 50 cents or whatever it might be. And that's not that mass exactly, but it becomes less over time. So I personally like going debt. The only thing, and
that's such a great point that I think is somewhat overlooked. If I had $500,000 and I stuffed that under my mattress, I would get yelled at by everyone, because everyone knows inflation eats away assets. But that's exactly what you're doing when you're getting $500,000 worth of debt. You're stuffing it. You're giving it. The bank has given that to you, and it's stuffing under their mattress instead of yours. So that money is going to get eroded by inflation.
Yeah, and the other benefit of that is if you're in an interest rate environment like we're in today, and an economic environment, I should say, where let's just call interest rates at 5%, but headline inflation, and it's complete rubbish, but headline inflation is 6.7%. Money is actually getting inflated away faster than faster than the amount that you have to make for repayments. So yes, you have to pay the bank 5% in interest repayments, but it's getting inflated away at 6.7%. So theoretically, you're actually gaining 1.5% per annum on your loan or the money that you're lending. So as long as you can comfortably make those repayments, make those interest repayments, and not put yourself in a financial situation that's awkward, you're actually not on paper, but theoretically making yourself money as time goes on.
Keeping all your properties, but paying down the debt. So this is a bit of an interesting one. So we're now looking at when we're putting debt into the equation and we're starting to pay that stuff down. What does that look like, Steve? Give us a run through.
Yeah, so same as before, but you're either physically putting cash savings into the portfolio to pay it down a bit quicker, or like John said, you're on P&I. It rolls over to P&I, and then you can plan from that point, okay, I'm going to be debt-free in 10 years time, 15 years, 20 times. And that's the biggest thing for this one, is you can actually plan it really, really well, because you know how much money you can put into it and what the P&I repayments are over what time frame. So you can get a kind of definitive line in the sand of exit date, we'll call it. So this is most people's exit strategy. Like 90% investors will have it, they'll switch to P&I, and then they'll pay it down. And you can phase into retirement, because obviously as you're paying down, your actual passive income increases as well. So it's the usual typical one that everyone kind of does. And then you can also kind of stage things with like the accountant as well. So like you're slowly building into it as you start retiring and your actual income starts decreasing, you can start increasing your passive income. So you kind of manage the tax brackets that way as well.
Yeah, right. Okay. What are some of the pros and cons of this one, Jordan?
Yeah, so this is what I like to call eliminating with cash. As Steve said, it's either like a hard cash dump into paying off the debt or paying P&I. So some of the pros that I wrote down is it's kind of a risk-free retirement. Like you're not susceptible to those interest rate movements or massive P&I rollovers into retirement, apart from like potential sort of major building defects that might come up and cost a bit. Like you're essentially risk-free without debt. As Steve said, it can be planned really, really well. Like you do have that line in the sand and can calculate how long it will take you to pay it off. And you still have to pay tax on the rental income. So that's probably actually one of the cons, is you have to pay tax on that rental income that comes through as you start to go through. There's no, like with the previous scenario, you do have the debt and the tax deductions on investment debt. So you get a bit of a win-win there, but heading into retirement with a rental income, you still have to pay those taxes. Some of the other cons is it can be a bit of a long runway to pay off that debt completely. So if like you've got this time period or this line in the sand, it could be sort of like 10, 15, 20 years away. And some people might have to continue to stay working over that period to pay it off completely before they go, I'm comfortable, the debt's paid off, I can retire now. They do lose out on the inflation eating away at debt. So same scenario before, but you don't have any debt going into retirement, which is less risky, but at the same time, you don't have inflation eating away at that. If you are using savings or you do have rental income coming through going into a savings account, obviously you're losing inflation on that on an annual basis as well. And then, you don't get any tax deductions on the debt. So, there's some pros and cons that I rattle through.
One of the points you mentioned there about the long runway, that's also where commercial property can actually come in, because with residential, like not many people pay off. I know there's some gurus out there that pay off it in 10 years, etc., etc. Just run a mile when anyone says that for residential. With commercial, you actually can pay off quite reasonably in 10, 15 years. So you can actually shorten that runway by throwing a few commercial properties into your portfolio and remove the risk of commercial that is long periods of vacancy. So that's where the actual planning comes in, because if you don't want to have a 20-year plan and you want to shorten it to say 10 or 15, high yielding properties might come into play. You might buy a house in Granny Flat or a little duplex or block of apartments or a commercial property just to fast track that one if you can't put that additional savings in yourself.
Do you guys have any thoughts on living off a line of credit, which I think is talking to this exact strategy?
Spot on. It's exactly what we just spoke about. Yeah, actually, a line of credit is it's you pulling out the equity and using it to live off. So people do it. It's not outrageous, but like me and Jordan said, you're not doing it at 80% kind of thing. And if you're spending, if the banks are giving you that LVR and you are spending it, you're asking for trouble. Like most of the time they give you that line of credit based on the premise you have to buy an investment property. And I know it's easy to say, yep, I'm buying an investment property, and they give you the line of credit. However, like if you spend it and the market goes bad, like markets drops 10% or something like that, you lose your job, you can burn your fingers very easily.
Yeah, exactly. And that's what someone says here. I always thought it'd be difficult refinancing with no job or income. So if you are looking to use this as your retirement, there are some people that rave about this as a strategy. In there, like there was this comment here, Michael Yardney raves about it in his books. Yes, that was a book that was written many, many years ago. So that strategy is now no longer relevant. And this is why it's so important not to have a static piece of paper strategy. Like the strategy that would have been written in this book in 2001, if you're still using that playbook, it just doesn't work anymore. You have to have the dynamic, tech-enabled platform like Jordan does. I'm not trying to push you here, not trying to push Jordan here, but I think it's so crucially important to have something that updates and changes with the situation that changes and the rules that change. The debt to income ratios are going to be shifting in 20 years time, as they had in the last 20 years when we had low doc and no doc loans for residential. Got them in commercial still. But that's probably going to change at some stage as well. And you have to be dynamic in your approach.
Well, one of the things that people always get confused about what banks are willing and not willing to do. I just look at it at the point of view is they're protecting their money. That's it. So when people go, oh yeah, but they're not going to service you if you don't have an income. Yeah, of course not, because they're worried if you don't have an income and the property goes bad, they do it from there. But that's also why they balance the LVR. And that's actually why with commercial, you need a bigger deposit, because they know if your tenant leaves, the property might be worth 20% less. They can still do a quick fire sale and get their money back. It's also the whole premise of lender's mortgage insurance. You are actually getting an insurance based on that you can't pay that thing and the property price drops more than, say, 10%. So that's the whole premise of the actual insurance. So if you look at it from the point of view of banks are just protecting their asset. So they either want to see a stable job, or you have an income, or the portfolio have an income. If that's not positive, then the LVR will be the thing that balances it. They want to see really low LVR so they can do their fire sale and flip the property. And then that normally answers 80% of the questions with lending.
Selling parts of your portfolio and living off the profit.
Yeah. So this is exactly the same as the last one, but instead of using that profit to pay down the debt, you're actually using that profit just to actually live off. So you're not paying down the debt. So it's sort of assuming that your current debt portfolio is positively geared. So it's kind of looking after itself or paying itself down. Otherwise, obviously the banks aren't going to let you do that. The reason why you might live off the profit is some people just want to have their effort moment where they just go off and travel the world for 2 years or something like that. Like, you know, most retirees, like they'll retire and then they go to their Europe trip and they go spend 50 grand on that. That's sort of what it's getting at. It's not, okay, you're not putting 50 grand back into your portfolio. You need that cold, hard cash to actually do something. And like a lot of people just set themselves up for retirement. So they'll buy like their boat, and then they'll have their holidays planned and they can do that. Same as above, it's just a little bit riskier because you've still got obviously the debt and you're going to lose some of that passive because you're not paying down the debt. So,
yes.
So like if you can live, actually you want to cash for do what they want to do.
Yeah. Okay. Well, you broke up a little bit there, mate. But Jordan, what are some of the pros and cons of this beautiful strategy?
Pretty much the same thing as the previous one. So you're allowing capital growth to do the heavy lifting. You can purchase specific properties to help you build that sort of exit strategy and living off the profit. Again, it can be planned and executed really well. And it's probably a bit more riskier than the previous one. The cons are the same as well. I guess one of the bigger cons with this is obviously you've got, as Steve mentioned, less passive income coming through from the portfolio. And like, it's great that you've got this lump sum of cash just sitting there that you can chip away at. The problem with chipping away at cash is that even if the portfolio is self-sustaining, which I think is important, you still have living expenses. So over time, if you don't have enough in there and you're chipping away with your living expenses at this cash, at some point in time, something's got to give. So you just want to make sure you've got enough in there with the profit and the cash to sustain however long retirement might be. And that's one of the funny things as well, is you kind of see these people retiring at 62 and then they've still got 30 years before they actually cark it. So like, you got to like, it's a lot of time to have to sustain yourself, especially when you have inflation, everything else coming into play with it. So it's just about making sure you're setting yourself up for that longer term period. And as I keep saying, like it doesn't have to be that line of the sand. Now we're going to sell 5 properties of the portfolio. You can sell like one at a time. Like you might sell one every 5 years and let the growth and the income come through as you start to go along. But as long as you know from the start that the get-go was, we're going to be potentially selling these properties as we head into retirement.
Yeah, there are some tax minimization benefits of doing that as well when you stage it as well. Because if you sell them all in one go, then you've got obviously the huge capital gains bill. But if you can you've got the right structures in place. And again, we said this at the start, having the right accountant planning this stuff out with you is really important because you can minimize some of the tax there. But like John, you've made a really good point of people also don't know how long retirement is. So that's where having a passive income helps. And especially if you've still got some assets as well, like property, you always move with the market, because if rents go up, guess what? Your passive income goes up with it. If rents go down, so will your rent as well of where you're living. So you can always kind of stay with the market. But that's a really good segue into the next one, Joe, which is basically selling the whole portfolio.
Selling the whole thing, the whole kit caboodle. Why the hell would we want to sell all of it?
Well, so I'm just going through some of Jordan's points here that he wrote out, but like the biggest one is you actually just want to have an extravagant lifestyle, and you might hate your kids. You're like, stuff you kids, I'm going to keep all this money, go buy my Ferrari and travel around on my yacht. But it just gives you the whole thing. But like I said, planning for retirement is tough because I actually have no idea if I retire at age 65 or 70 or whatever it may be, if I'm going to live to 80 or I'm going to live to 110. Like modern medicine might keep going. So that's what I like about property, whereas this one gets rid of that. Sometimes people do this and they sell the whole portfolio and they realize that they're not necessarily just having the money sitting in a bank account and they're going, oh yeah, I'm just going to chip away at this for the next 30 years. There are very low risk investments, and I'm not going to go too much into it because I'm not a financial advisor, but you can buy certain investments that are just kind of low risk and they try to match inflation, and then you just kind of live out your time over thing. But a lot of the times, you'll actually see parents do this when they're trying to buy and they shift the funds into their children. So they'll actually give their kids all the deposits for their houses and things like that. So it's not necessarily just like, oh, I'm going to spend all this money. It's using it some wisely. But there's nothing wrong with this strategy. You just lose out on all the capital growth and you lose the passive income, in quotation marks, that you would have had from all the other strategies.
Yeah, 100%. And like if you are selling down the whole portfolio and just like having a big lump sum sat into your bank account, it's not really doing as much as you can. But also on the same token, if you just want a passive income of $80,000 and you've got a large chunk that you can put into some very low risk, low return asset, but if it gives you that $80,000, then who cares? It's giving you what you want. So maybe that's the lifestyle that you want to live. It's fine. What have you got down there, Jordan?
Yeah, so I'll just reiterate some of the stuff that Steve mentioned that we've got in the notes, but you could find that really good lifestyle. Like if you sold your portfolio and you had $5 million or whatever it might be, you know, and you really wanted to buy that yacht, or you really wanted to go sail the Greek islands for 3 years, like you can do that. You can find that extravagant lifestyle. You just have to really plan out how long those funds are going to survive and last you through that retirement period. Risk-free in terms of not having the debt and the interest rate movements. Again, it can be planned and executed really well. You're essentially buying and building a portfolio to sell off. And you can stagnate those property sales as you start to go along. Again, as Steve mentioned, with the tax benefits. Some of the cons is, again, the no generational wealth play. So you're really just stuffing the kids there and not being able to pass on that legacy. You'll need to time that exit correctly. Make sure that the funds don't run out over that retirement period. Sale and exiting costs, again, is a big one. So 3% on the way out plus capital gains tax is a lot of money. Where if you had kids, you can pass that on instead. Inflation is going to eat away at that savings. So let's say, again, in that scenario, if you had 5 million in savings, it might be a lot of money now, but over 20, 30 years, inflation is going to eat away at that as well. And you might run out at some point, and you don't have that passive income, as Steve was mentioning, with the growth of the economy and the market and rents and everything else that goes along. You get the benefit of that if you stay in the game. Whereas if you exit out of the game, you're susceptible just to your lump sum of savings that you've got on the journey.